The Trump accounts are coming. This is going to be big for the market and investors like you and me. $1,000 in an investment account from the US government for each child born between 2025 and 2028. And it doesn't matter whether you will have children or not, this will heavily impact the stock market. So, no time wasting, let's break it down clearly: what it is, when it begins, who benefits, how you open one, who manages it, whether the government is funding it, and what it means for markets. Here's what a Trump account actually is. Think of them as a starter, kid-sized version of a traditional IRA, with special rules while the child is under 18. The headline is simple: start investing early, let compounding do the heavy lifting, and build a culture of ownership. Legally, it's a new type of traditional individual retirement account created specifically for minors. The child is the owner and the beneficiary of the account, but the account follows a special growth period set of rules while the child is under 18. The whole idea is to lock the money in early, invest it in plain vanilla US equity index products, and let it grow for years before the first dollar can be withdrawn. That lock-in is not an accident. This program is designed to force time in the market. Now, when does it start? The rule that matters for families is this: contributions can't start until July 4th, 2026. That means you can't fund it today even if you're excited, but you can prepare for it, because opening the account involves a formal election through the tax system. And who is eligible? There are two layers. First, a child under 18 with a valid Social Security number can have a Trump account. That's the broad eligibility layer. Second, the special government seed money, the one-time $1,000 deposit, is only for eligible children born between January 1st, 2025 and December 31st, 2028, and they must be U.S. citizens. That's the narrower layer, and it's the part that turns this from a new account type into a real government-funded starter investment. So yes, the government is putting money into these accounts for a specific cohort, but it's a one-time seed, not a monthly check. Now let's talk about who can add money, because this is where the design gets interesting. During the child's under 18 growth period, contributions can come from multiple sources. Parents and guardians can contribute, other people can contribute too, employers can contribute, and there's also a category for contributions from government entities or qualifying charitable organizations for a class of kids, like children in a certain state or born in a certain year. But there's a cap on most contributions. The core annual limit is $5,000 per child per year for regular contributions during the growth period. Employer contributions have their own design, and the program also makes room for certain government or charitable contributions that can sit outside that normal cap. Here's the point: the $1,000 government seed is meant to get the account started, but the real outcome depends on whether families, employers, or outside sponsors add to it over time. Now, the next big question is, what can the money be invested in? This is not a pick-your-favorite meme stock account. During the growth period, the money can only be invested in what the rules define as eligible investments. In plain English, that means mutual funds or ETFs that track an index of primarily US companies, don't use leverage, and keep fees extremely low. The program is trying to steer money into low-cost, broad market exposure, not speculation, so it's basically building a pipeline into passive investing. Next, when can the child withdraw the money? The program is strict here. During the growth period, distributions are generally not allowed. The idea is no early spending, no cash out at 16, no draining it for random expenses. There are narrow exceptions like specific transfers or administrative cleanups, but the normal rule is you wait. Then, starting January 1st of the year the account holder turns 18, the Trump account begins to behave more like a normal traditional IRA under the tax rules. That means withdrawals can be taxed as ordinary income, and there can be penalties for early withdrawal before retirement age unless an exception applies. In other words, at 18, you gain access under IRA-style rules, but it's still designed to reward long-term holding. Now, how do you actually start one, and who manages it? The account is created through an election process. Parents or guardians make the election by filing the required IRS form to establish the initial account for the child. After that election is made, the Treasury sets up the initial Trump account and provides the steps to activate it through the official process. In terms of who manages it, think of it in layers. The Treasury creates and organizes the initial account framework, and the IRS handles the election and tax rule side. The assets themselves are held by a trustee structure, meaning the account can ultimately be custodied and administered in the way retirement accounts are normally handled. And the rules also contemplate that an account can be moved through a full trustee-to-trustee transfer into another Trump account structure, which is basically how you shift administration from one provider setup to another without breaking the rules. Now let's get to the real-world question. Who benefits? If your child qualifies for the $1,000 seed, the child benefits immediately. That's free capital placed into a long-term compounding machine. But the bigger benefit goes to whoever can consistently add money. Families with extra cash flow can contribute more easily. Employers that decide to contribute can boost the account meaningfully. And if states or charities fund broad contributions, that can spread the upside further. This is why you'll see a debate around fairness. Supporters will say it's expanding ownership and building a long-term saving habit from birth. Critics will say the biggest winners are families who already have the spare money to keep contributing year after year, because the $1,000 seed is nice, but the compounding really accelerates when contributions stack. Both can be true. The program's baseline is universal-ish access for kids, but the outcomes will likely be unequal because the ability to contribute is unequal. Finally, why is this such a big deal for the market and all investors? Here's the first mechanism. Direct demand. For eligible kids, the government seed money goes into investments that are basically broad U.S. stock index funds. That means new money is mechanically buying U.S. equities, not trading, not timing, just buying and holding. That creates a small but consistent bid under the market. Second, the follow-on effect. The $1,000 is just the spark. The bigger impact comes if parents, relatives, employers, or sponsors add money every year. Even modest contributions, repeated for 10, 15, 18 years, can turn a one-time deposit into a real pool of long-term capital. And long-term capital tends to be sticky. It doesn't panic sell headlines, it just keeps compounding. Third, where the money goes matters. These accounts are designed to push contributions into low-cost index-style investments. Index flows don't spread evenly across every stock. They overweight the big indexes, meaning the largest public companies tend to benefit most from steady passive inflows. That doesn't guarantee higher returns, but it does mean incremental money disproportionately supports the broad market's biggest names. Fourth, it can lower the equity risk premium at the margin. Translation: when more of the country becomes long-term equity owners, markets often trade at slightly higher valuations because there's a larger base of buyers who invest automatically and consistently. You see this logic in 401 and target date fund flows. Again, this is a slow cultural effect, not a one-week catalyst. And lastly, there's a second wave beyond the government. Companies and philanthropists have already talked about matching or adding to these accounts in large dollar terms. If that actually scales, it becomes additional passive buying pressure on top of the initial seed. So the clean takeaway is this: Trump accounts are a new child-focused, IRA-like investing structure, seeded with $1,000 for a specific cohort of U.S. citizen children born between 2025 and 2028. Contributions begin July 4, 2026. The investments are constrained to low-cost, U.S.-focused index products. Withdrawals are locked down until adulthood, then shift into IRA-style rules. And the biggest winners will be the kids whose families, employers, or communities keep adding money over time. Trump accounts probably won't move the S&P 500 tomorrow, but they can act like a slow drip of new long-term buyers into U.S. index funds. And over years, that kind of flow is supportive for the market and for existing investors already holding broad equities.